Hey everyone, me Kevin here. In this video, we're going to talk about the bubble, the market bubble that keeps blowing and blowing and blowing. We're going to go into it and a danger that is forming. I'm going to tell you exactly where I'm looking at this, and it's kind of bugging me a little bit because it's not acting the way I suspected it would. And I always like to point out when I'm wrong because you learn the most when you're wrong. So let's talk about that in just a moment, because I have to remind you that today is Memorial Day, which means the amazing programs on building your wealth have a wonderful price increase tomorrow. So take advantage of that coupon code link down below. You get 39% off. You get access to my private live streams guaranteed through the end of October, if not longer. And of course, you get lifetime access to all the content. So anytime content is added, you get access to that. So whether you bought it 2 years ago or yesterday, you always get all the new content that's in, and that'll always remain to be true. So check that out, link down below. Okay, now let's talk about this bumble thing, okay? Here's the thing. So this is bugging me a little bit, but y'all know what margin debt is, right? Look, it's debt against securities. So if you have $100,000 of Tesla stock and you take out margin of $30,000, you're 30% in debt, right? And the reason I like looking at margin debt is specifically because of what happened before 2000. Yes, the stock market bubble, the internet bubble of the dot-com era, the year 2000. Take a look at this. This is a little scary. So if you jump on over here, this is the year of 1997. And what you're going to see is margin debt fluctuated between around $103 billion to $131 billion. And then over here in 1998, margin debt fluctuated upwards, closer to $150 billion. Then margin debt fluctuated up to about $200 billion. We crossed 200 billion, and by the beginning of 2020, we got to $241 billion. And at the beginning of the year in 2000, we were around 260 billion, 284, 300 again. And when the dot-com era started coming to an end, and we started having a collapse in stock market prices, we actually started seeing stock market margin debt rapidly decelerate. Look at this. From March to December, margin debt went from about 300 billion to around 210 billion. And if we look at the Dow Jones, for example, we could do it with the S&P 500, but honestly, it doesn't matter so much. Go over to the year 2000. You get to this incredible run up leading into roughly around 2000. But between 2000 and 2003, you actually had the Dow lose money. Look at that. You were down about 28% from the beginning or around the end of 1999 to about March of 2003. Let's go ahead and try that with the S&P 500 because, you know, it's not always up. Like markets can trade sideways for a while. Take a look at this. You take the beginning or about end of 1999, and you take that out about 3 years. Look at that. You get a negative 41% return in the stock market over a 3-year period. It's a long time, right? But nonetheless, long time. Had you been just buying index funds, you would have lost almost half of your money just buying the S&P 500 during that 3-year time frame. It's a lot. And so what you really saw is in 2000, you really started seeing margin debt evaporate. In 2001, you went, instead of being all in the 200, almost $300 billion margin range, look at this. You went back to 198, back to 183, back to 150 over here. And in 2002, it was under 150 for the majority of the year. And it wasn't really until 2003 when prices started picking up again that margin actually started going up again. Obviously then margin goes up, up. Look at that. We're almost back to 300 billion. Now we're over 300 billion in margin debt. Oh, wait. But then 2008 comes around and we go from almost 400 billion to, no, back to low 200s. Look at this. After September especially, you know insane liquidations happened here. Because look at this. You went from 245 billion to 210 billion in like 3 months. That's crazy. And really, you got 2009 brought you back into the 199-ish range. And and then we got to get all the way, I got to scroll all the way up here because they measure two different things, these charts. So then you get all the way to where we have the comparable time frame. Here we go. We get back to 2010 and you slowly start seeing margin rise again. You're somewhere here, 263 billion, slowly starts going up to 300 billion, right? Coming out of the big market crash. But now we're printing money like crazy, quantitative easing like crazy. Rates are cheaper than they've ever been. So in 2011, you blow it up to 360. Then you're bobbing around the lower threes in 2012. Still had some reverberations of bad market juju in 2012. 2013, you blow up margin debt as the real estate market finally starts taking off around April and May, which this is not real estate debt, this is stock debt, but they can still be correlated since investors often own both assets. But anyway, towards the end of 2013, you're almost knocking on the door of 500 billion in margin debt. 14, you get to 500 billion. Then in 2016, you're also still around 500 billion. 2017, you get to $600 billion. 2018, you're like 665 billion, fluctuating around there. 2019, back into the high 500s. You had a slowdown here since, remember, at the end of 2018. And look at this plummet. I mean, you went from August of 18, 652 billion, to 554 at the end of 18. Guess what happened in this time frame, folks? Yeah, the market crashed. Like the end of 2018, people don't like talking about the end of 2018 that much. I mean, relative when you have this zoomed out, it doesn't matter so much. But look at this. From August 18 to about December 18, the market lost, it was about 20%. It's hard to pull it here. But we had about a 20% sell-off in the S&P. Nowhere near as bad as that 3-year period at the beginning of the 2000s, but you still had a good 20% S&P sell-off. But it's something to pay attention to. Every time we see the margin debt size down substantially, it usually is coming from this high level that it's never really been at before, and then going to a low level in a crash as people get wiped out, right? We literally saw that in 2000, went from a high level we've never been at before to a low level, saw that in 2008, saw it a little bit at the end of 2018, and look at this, we saw it again here in 2020. Look, in February 2020, we go from $545 billion down to 479 in March, very, very short and deep kind of recession, and so we quickly bounced back. But what did Congress do then? Print money like crazy. By the end of 2020, we're at $778 billion in margin debt. Never been at these levels before. And literally every month this year, we have been adding new levels. We are at $847 billion in margin debt right now. Now, I thought back in February that because we started seeing a slowdown in the rate of growth in margin debt, like over here from 722 to 778, this is a 7% increase in margin, which is crazy. And I thought because this rate was slowing from 813 billion from January, this is only a 1.8% increase right here. I thought, oh, that's it. This is the market slowing down and we're going to potentially see another sell-off in the market. Now, we did see a sell-off in parts of the market like tech, and we saw a sell-off in some consumer discretionaries online or biotech. But folks, the debt bubble continues to go, and it's not slowing down. Sure, over here it only grew 1.8%. Over here to here it grew like 1.8%. But guess what? It accelerated in April. It went to 3% growth over here in April, and I'm thinking to myself, oh my gosh. Like, despite all of this in the stock market, people are more and more okay with taking on more and more debt. And I think that's the last thing we really ought to be doing right now is more and more debt. Debt. That's everything we've got going on. Debt right now. It's crazy. And so part of me is a little bit concerned that, okay, we got to pay attention to this because every time margin debt has hit new crazy highs before, we've had some kind of correction. Now, sometimes it's taken years to get that. I mean, we bobbed around the 500s, the 600s for quite a while, but margin debt is going to hit $1 trillion soon. That's pretty incredible, and it just makes you wonder, if we keep growing at 3%, well, do this. 3% on 847 times 3% again. So if you had 3% month-over-month growth for the next 2 months, folks, we would be at about $900 billion. And it doesn't take much longer after you hit 900 to hit $1 trillion. Let's do it. So if in 2 months we could hit, so by July we could hit 900 billion, we could literally break over $1 trillion in margin debt by October. And we've, like, literally the past decade, we've been averaging maybe around 500 billion. So by October at this pace, we could literally be double our long run average of debt in the market. And it just makes you wonder, this debt doesn't even include a crypto debt. Is there a potential for the Ray Dalio style great deleveraging to come? Now, the next time we get an update on this will be about 2 weeks into June. But I want to pay specific attention to this because I really think debt levels in our markets are getting out of hand. Now, I know a lot more money is floating around, but still, and also because rates are so low, people have more and more debt, and it makes you wonder if in 2023 the Fed does start bumping rates. That's a lot of money that is now paying a higher interest rate. And so it's definitely something that to me feels slightly concerning, something that I really want to pay attention to more. And I'd like to see this number actually healthily trend down or stabilize. I do not want to see this number rocket, because if this number rockets and starts growing at 5, 6, 8% again, I think there's a real risk we might be setting up for another pop in the margin debt bubble, kind of like 2000 and 2008, or what we briefly saw at the end of 2018, which was short but pretty painful too. So watching this margin debt number continue to skyrocket, not good. Continuing to go up, bad. Growing slowly and steadily, better. Number going down, probably needed. So anyway, something I'm watching of. It's just one of many, many statistics. As always, if you like this kind of content and perspective, hit the subscribe button so you can stay tuned anytime I'm looking at something that is worth paying attention to. Let me know what you think in the comments down below, and we'll catch up in the next one. Check out those programs, use that coupon code, and thanks again.